Good morning, everyone, and thank you very much for joining me. This is the DAX Open with myself, Russell Shaw, and I'm the Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com, and today is the 7th of January 2022. I just want to bring up our high-risk investment warning. I'll keep this on screen for a few moments. We're doing a live trade today at 3:20, so please join me for that. I'm just popping the link in the chat. So if you'd like to join us for the live trade, when I say live trade, it's going to be a live trade on a live account. When we do our when we test our scalping, that's still testing on the demo account, but the non-farm payrolls will be a live trade live account, so join me for that. The link is in the chat. Let me bring up our market commentaries disclaimer. I'll keep this on screen for a few moments as well. And our references, MarketScope 2.0. We'll start off with the CNBC European note over here. And then I just want to show you an interesting relationship on TradingView. So let's start off with the CNBC morning note. So the headline: European stocks lack direction after sell-off, investors waiting for the US jobs numbers. All right, so European stocks, we're looking at a mixed open. Friday as investors wait for this key jobs data. Market's still trying to digest the US Federal Reserve's more hawkish tone in terms of its minutes. Let's just see if they mention anything about the minutes in the article, and I'll just tell you sort of what I've noted. Minutes from the Fed's December meeting revealed a hawkish stance within the central bank. Yeah. This is it. Officials said they are ready to not only increase rates, okay, and reduce bond buying. Sorry, they're ready to not only increase, I beg your pardon, increase rates and reduce bond buying. Now this is the key part here. But also they've had conversations about lower holdings of treasuries and mortgage-backed securities. Okay, so this over here. It's interesting that it's been brought up now because the balance sheet for the Fed. So what the Fed's been doing is they've been buying fixed income treasuries all along the yield curve. So they usually operate on the short-term instruments, but they go all along in QE, and they buy mortgage-backed securities all along. And then what they do is they capitalize that. Okay, they book that onto their balance sheet as and the balance sheet grows to the point now that they're holding in excess of $8 trillion of these bond securities on their balance sheet. So what that's effectively doing, as the Fed's buying these bonds, it's injecting money into the economy. So they're taking hold of the security, but they've got to pay for it. So whoever they're buying the security from receives the cash, and that cash is now in the economy, and it's making the economy more liquid. So this now is going to be very interesting how the Fed manages this, because if they're going to start sort of normalizing the balance sheet, that means they're going to have to be selling those holdings back into the market. Now, just think what that's doing. That means they'll send the security out into the market, and they'll receive the cash. So they're siphoning liquidity out of the economy. They're siphoning. So what's happening to money supply? Money supply is starting to contract. A dollar money supply will start. And that's probably going to start happening soon. I mean, there's no timeline here. There's no schedule, but that's going to probably start happening after they kick off the rate hiking cycle, which the market expects in about March. So there's effectively three things happening here. There's tapering the bond buying, okay, and the bond buying probably concludes in March. They're going to look to raise rates. Markets expecting rate hikes in March. And then the third is that they want to start normalizing their balance sheet, which means that they're going to start sucking liquidity out of the economy. And that's why the markets are so nervous. Okay, so I think it's a conundrum for the Fed, because it's got to be managed exceptionally carefully. And the reason for this is because the markets are addicted to liquidity. Now, it's kind of like going to somebody that's addicted to sleeping tablets, and then just taking the sleeping tablets away. I mean, it's probably healthy in the long run, but the shock in the short term, unless it's managed correctly, there's a real danger there. All right, so let's just go down a bit here. All right, so tech stocks were particularly hard hit, and we discussed that, I think, 2 days ago. Tech stocks were hit because they are more sensitive to rate hikes than your blue chip cyclicals. And the reason for that is time value of money, because $1 today is worth more than $1 tomorrow. Tech stocks pay dividends further down the timeline. Mature cyclicals pay dividends closer, okay? And the way that the time value of money formula or equation works, the interest rate is going to knock the tech stocks more than the cyclicals. All right, so that's why we're seeing 10 years or 10-year yields starting to move up. And then we're going to have the jobs report today. Economists have estimated that the US economy adds 422,000 jobs in December. So we'll trade that. Unemployment rate expected to come in at 4.1. Back in Europe, investors will be looking at new trade data from Germany and France. There will also be a flash annual inflation figures for the Eurozone and new consumer confidence. All right, let's see, anything else here? On the political front, Foreign Affairs Minister of the North Atlantic Treaty Organization are gathering virtually to discuss Russian troop buildup near Ukraine. Okay, the meeting precedes high-level talks between Russia, the US, and NATO next week. All right, so that sounds quite it sounds quite scary, to say the least. So we'll just keep an eye on that. Let's go through to our trading view before we do our DAX. And good morning, Robert. Nice to have you on the webinar. And terrific question here. Does it matter to the market if they sell the assets for a loss or a profit? Let me think about that. I don't think that it is as big a deal to the Fed as it would be to a sort of, I guess, a traditional type of investor. The whole point about QE was to ensure that the economy transmission mechanisms are well greased, working well, and that's sort of the markets are effectively supported. They weren't going in there to make a gain, a capital gain. The Fed in of itself is going to start influencing yield. It's going to start influencing interest rates upwards. So the likelihood of them making a capital gains diminishes because they are buying bonds. Okay, they're buying fixed income instruments, and that started in March 2020 when interest rates were very close to the zero bound. So what we know is that yield is inversely related to price. So as the yields start moving up, it's quite likely, and I would say it's almost a guarantee, almost. I don't want to say it is a guarantee because, of course, nothing is definite, but it's very likely that bond prices are under pressure. And given the fact that they're under pressure, there is, I think, a chance that the price of these individual assets are probably going to be lower. So my thinking, Rob, and again, subject to correction, is probably not. I think the whole idea is for them is to try and sort of almost get a market that is addicted to liquidity, sort of to stabilize. Does that make sense? That's kind of my first thoughts. I've perhaps got to give it a bit more thought, but I think they're almost guaranteed of selling at a capital loss here. I don't think that's the too much of a concern for them. In fact, that's a good segue into this chart here, and what we have on screen is 3 charts. The top chart here, this is gold. Okay, so the top chart here is gold. The middle chart here is what we call REF. So REF is an exchange traded fund, an iShares exchange traded fund. It's measuring bond prices, not yield. It's measuring bond prices around the 7 to 10 year range. So that's what REF is. And then over here, I've got the actual US 10-year yield, and REF is would be US bonds. And what's interesting to me is just the correlation between gold. Let me just move this over. Okay, so we're going all the way to around about the 4th quarter, let's say, of 2018. So you can see gold appreciates. Okay, look at bond prices. Bond prices appreciate. Look what's happening to bond yields. Bond yields coming down, right? Now that takes us through to the, let's get this out the way. That takes us through to the sort of the midpoint of 2020. Then we get gold prices moving down, we get bond prices moving down, but we get bond yields moving up. Okay, and then that brings us through to the first quarter, the end of the first quarter 2021 till the present. Here we've got a slight increase in gold prices, a slight increase in bond prices, and a slight decrease in yields. Okay, so what we can infer from that is gold is very much acting like a bond. In other words, yields seem to be having a very similar impact on gold as they would have on actual bond prices. Now, what's the big deal? The big deal is we've got these Fed minutes that are very hawkish. Now, we've got to be very careful here because the Fed's been kind of behind the curve from the get-go. So, you know, when the whole market was suggesting, well, we've got inflation, the Fed was saying, well, no, guys, we've got transitory inflation, and the market's thinking, are you guys sure? And the Fed's, we've got transitory. And if you read the Fed minutes for December, it's like, we're very worried about inflation. This is much more rampant than we thought. I mean, the market kind of knew that it was a more sustained inflation. The Fed kind of waited really until the last minute. And now the Fed has gone sort of extremely aggressive. So it's not to say that they might not soften the stance somewhat, but at the moment, the Feds are reading extremely hawkish and extremely aggressively aggressively hawkish. So what does it mean? It means the prospect for higher rates cannot be ignored. It's quite likely that we do have higher rates. And if that's the case, well, we'll start off from the bottom. Higher yields, and I've got this sort of black arrow question mark. Probably with that, if that's the case, then we would expect to see lower bond prices. That's just the way the bond mechanisms would work. But given the relationship that gold seems to be having towards the price of bonds and the yield of it, we'll expect gold prices down as well. And that is very, very interesting, because everybody is saying, well, gold's the perfect hedge against inflation. Gold's the perfect hedge against inflation. And I don't think that's the way gold behaves. Gold reacts to whatever's happening with the US dollar, because we've got gold as the numerator, US dollar as the denominator. So however inflation affects the US dollar, well, that's going to ripple onto gold. So we just want to keep an eye on this relationship. By the way, it's not only gold that we can do this type of analysis. We can probably do it with a lot of the real assets. The one that comes to mind would be Bitcoin, right? Which Bitcoin, I haven't done this analysis, so it'll just be very interesting to see. I'll use this one, which is the trading view data. Let's see what we've got here. All right, let's see if we can come up with any sort of inferences here. It's not quite as clear. Let's just see. All right, so we'll start here. Okay, so the relationship here with Bitcoin is definitely different. You can see that this over here is a different. I've probably got to give this some more thought, but I thought it would be a good idea just to take a look at it. Yes, it's a slightly different relationship here. What am I doing? Maybe give this some more thought, and then we can revisit this next week. I thought there might be some sort of pattern that's clear, but it's so definitely not as clear as the gold relationship. Gold seems very closely related to bonds. It seems as if gold being a safe haven, bonds being a safe haven, there's almost a sort of a sensical match there. Bitcoin certainly not not following that pattern. So I'm going to move on to the DAX. I'm going to have to give this the Bitcoin relationship more thought. And the reason why I thought it would be interesting: Bitcoin numerator, US dollar denominator. If the interest rates start moving up, well, one would suggest that's dollar supportive. If that's dollar supportive, it looks like pressure on the numerator. What is that? Pressure on the crypto. Okay, so we'll probably need to explore that next week. All right, let's just let's bring up the DAX and see what's happening here. Okay, let's go through to this chart here. So we'll do a top-down analysis. All right, it's just an interesting chart in that the selling tail here is quite pronounced, isn't it? We drew this in, did we draw it in yesterday? So it was a strong looking bullish candle for the week over here. And the question was asked, well, how are we going to end? Are we going to end sort of this gravestone doji, which effectively you open low, bulls push price high, but at the high of the week, the bulls lose control to the bears. Bears push down, and the week closes with the bears in control, and it looks as if that may be what's playing out, and it's right at this resistance level here, right at this resistance level here. What is interesting about the DAX is that it is more cyclical in nature. It's kind of, if you had to compare it to some sort of US index in terms of cyclicality, you'd probably look at the US 30, the Dow Jones, and the DAX, and say, okay, those are probably got the most similar characteristics. That being the case, the sell-off in equities, in my estimate, probably don't hit the DAX quite as badly as, say, the NASDAQ. Nevertheless, it's still something that we got to just keep an eye on. In other words, sort of a rotation from the growth side of the market into the value sort of cyclical side. What we have here is a higher trough, a big one, a higher trough followed by a higher peak. So we've got the trend, but this resistance level here really kind of stopped it in its tracks. Some sort of movement like this, I don't think would be all that bad. It would be trough, peak, higher trough, higher peak, maybe another higher trough in the series and another higher peak in the series. So we just kind of watch for that. But the sentiment currently, as we chatting, does seem on the negative side. Going back to the weekly chart, the stochastic is really the big deal here. We need to get the stochastic up into the 80 to see a confirmation of underlying bullish momentum. Okay, and just to reiterate why we want to see that, let me bring up my Microsoft Paint. All right, so to me, this is the easiest way to explain the stochastic. And for me, the stochastic is my favorite indicator. Everybody's got their own, but let me explain why I really like the stochastic. So just think about this in terms of a normal bar chart or a candlestick chart. So you've got here the range. What's the range? The range would be the high and the low, right? So whatever we're measuring here, there'll be a range. It will trade towards the high. That's the high, so it will be a trade between the low. Let's assume that there is the open over here. Okay, so it opens, trades slightly down, and then there's a big movement up. And let's say it closes here. And if I had to ask you guys, well, is this a bullish candle? I think we would all say this is a very bullish candle. We opened low, we closed high, we've kept the momentum at the close. It's really looking good. But if I said, well, what about this candle? What's that in terms of momentum? And you'll say, well, look, it's a positive day, but you know, the bulls kind of gave some back. The bears really pushed them towards the end, not as bullish. So this is exactly what stochastic is. It's exactly what stochastic is. So if you go through to the stochastic chart, it measures between 0 and 100. 0 is the low, 100 is the high, over, on our settings, a 15 period. So over 15 weeks. There is a slowing factor here, so it's perhaps not 100% comparable, but the slowing factor here just means it's going to be a lag. But it suggests that anything in above 80, well, that means that current price close is in the top 20% of the range, right? The upper quintile. So the idea here is we want the stochastic to get back above 80 and hold. If we get back above 80 and hold, that's where the magic tends to happen. Okay, and then over here you can see the momentum faded, but So we've crossed positively. It's now, do we get to the 80 level or not? The issue that we have is that although we've got the positive cross, there's resistance that's affecting the price, and that resistance on a fundamental level is because of the hawkish nature, the rotation of central banks. So if we go now to through to our daily chart, we're actually still in zone 1. And let's put in our lines 1, 2, 2, 3, 1, 2, 2, 3. Okay. What do we see here? We're seeing a dip in the uptrend. Okay. Seeing a dip in the uptrend. So whilst the market is nervous, I think we should be looking to see, well, is this correction, is this dip something that is potentially exploitable? Now, it might not be, but the fact of the matter is we do have a higher trough, higher peak. Understandably, there is some overhead resistance, and we're in, but we're in zone 1. Go down to the hourly chart and to see if we can time it in. So here you can see 1, 2, 2, 3. This was yesterday. So what happened yesterday is we did get the signal. Okay, we did get the signal here, but guess what? We didn't make it through to the upper quintile. So the momentum was never going to work. Once it's not going to make it to the 80, the trade's probably not going to work out. And you can see that it's completely different to what happened here. Here is, it holds up a quintile. There's the movement in the price. Okay, so the next signal, I think, is something that we need to keep an eye on. So let's just be quite loose with this. This over here, we're gonna watch the S1 level, and we'll see if the S1 level provides any sort of support. We don't want to predict, okay? We don't want to make any forecasts here. All we're going to do is we're going to look at the S1 level. We're going to see if it holds a support, and then we're going to wait to see if the signals trigger. Okay, so let's just assume that we get the 2 triggers. So we get the EMA cross, we get the stochastic cross. Well, that's the first part, okay, of the system. The second part is, well, do we make it up to the 80 level? Do we have the momentum? Do we have the market cooperating? And is this a potential buy the dip in an uptrend type of scenario? So that's what I think is what we need to keep an eye on just for the first part of the day. If it hits S1 and drops through, okay, well then clearly the risk off sentiment continues to haunt the market, and we're going to have to just respect that. All right, if there's any questions, please go ahead and type that in. Any questions? There is a live trade on. We're not going to do the US Open today, but we will do the NFP trade. All right, nothing coming through. So I think what we'll do is conclude at this point. Thank you very much for joining me this morning, and look forward to speaking with you a little later in the day. Thanks, guys.